Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and we are in roughly the same place that we were about a week ago with respect to the markets, kind of in a bit of a rock and a hard place right now between markets being fairly overbought, but not really seeing a lot of movement. Earnings season providing a little bit of volatility. We've seen some substantial moves here from, I would say more muted moves, if you will, from financials after what have been some blowout earnings. You have some airlines reporting, getting a little bit of getting weaker. You have some staples names, you have some technology names reporting, moving a little bit here to the upside, but largely so far still a fairly muted earnings season. But we do have some pretty big names coming up this week. So we want to take a look at how do we position ourselves in this type of market environment where we are fairly overbought and stretched to the upside, and what kind of positioning we can look at from the current market conditions. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So when we take a look at the markets here, we'll start off with the major markets. We'll take a look at where we currently sit within the major markets in terms of the major indices. Then we'll take a look at sector rotation because we are seeing we're starting to see a little bit more of sector rotation after 2 weeks of what has largely been technology and discretionary leading the markets higher. We're starting to see those sectors weakening, and we're starting to see some of the more defensive sectors strengthening here. Not quite there yet, but we're starting to see a little bit of rotation, which is good to see that as the market reaches these types of tops. We want to take a look at fixed income and gold, where the treasuries are currently trading, where the 10-year yield is currently trading. That's going to provide some insights into how equity markets may perform going forward. We'll take a look at some of the economic data, some of the concerns that we have there, and then share with you some of our ideas, how we're thinking about the current market environment that we are currently in. Let's go ahead and get started. But before we do, what I want to help investors understand from today's session is really where can overbought markets like they are now, where can they move next? Can they continue to move higher? Does that mean that we're definitely going to see a pullback here? That's really the question that I want to help investors answer. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to share with you my charts, my technical research, my economic research, and how I'm thinking about the markets in the current market environment. So when we look at the S&P 500, we clearly see a strong uptrend here to the upside. But by all accounts, I would say that this market is overbought, whether you look at weekly RSI, whether you look at daily RSI. The good thing is that as markets continue to make a higher high, momentum did confirm that higher high. So we're not talking about a large amount of negative divergence that typically we see right before a big sell-off here. But however, we have spent quite a bit of time melting up, basically moving higher here without any strong fundamental reason for that big move here to the upside. So markets are in a bit of this hard place in a rock here because of the fact that there's not a whole lot of upside left after such a big move. But also we don't see any strong catalyst to move things to the downside just yet either. So we're kind of just stuck here in this particular range. But however, when we look at the major markets, not all major markets are stuck here. If you look at the NASDAQ 100 index, NASDAQ 100 putting in what looked like a double top here, so far is holding that support level. And the question is whether this support level, this small support level, will hold and technology stocks will continue to move higher, or you're likely to see technology stocks start to move lower here. Now, looking at the earnings season so far, this certainly wouldn't put a retest here about this 323 level here to the downside, in my opinion. I think is possibly more likely given the outcomes that we're starting to see from the earnings season, where stocks that are beating are not really moving much higher here. IBM, a bit of an exception here, moving about 4 or 5% higher overnight after reporting earnings last night. So technology stocks so far is really where we want to pay attention to. There are some big technology stocks reporting this week that's going to provide us with some insights into perhaps how the NASDAQ 100 will perform. But when we look at IWM, the small cap market, it's still range bound here, stuck here between this 215, 225 level here to the upside. Now, this is really out of all of the markets, the least overbought. in my opinion, has the potential of finding a little bit of support and retesting that 235 high, and then potentially breaking out higher above that if the other major markets can continue moving higher here. So as IWM small caps have lost a lot of relative strength here, relative to the S&P and the NASDAQ, it is starting to provide a little bit of defensiveness here over the past couple of weeks as it continues to remain range bound and potentially has the opportunity to move here to the upside. And when we look at market breadth here, if we look at RSP, the equal weight S&P 500 index, this is really one of the things that is still encouraging about the market that we are in, because normally near market tops, you tend to see a few of the large cap, mega cap names dragging the markets higher, while the broad-based market kind of is at a bit of a standstill here, but that's not what we're seeing. We're seeing that the equal weight S&P 500 market is moving as high or sees the same amount of performance as the market cap weighted SPY. So this is suggesting that market breadth here is still relatively strong, that there's a fair amount of support, and the health of the market rally here is still relatively strong. So for those reasons, you don't have a strong catalyst for, exhaustion. You don't see the classic examples of exhaustion you see near market tops where you before a correction. And largely markets remain fairly healthy. So the last thing we typically look at is, foreign markets. We look at sector rotation as evidence to see if there are some signs of healthy market rallies or not. And if you look at, value versus growth here, value versus growth is back near a support level. So we talked about this underperformance of value versus growth for multiple years. Value has underperformed growth, but it has put in this bottoming formation here for multiple months during the pandemic, and finally broke out here a couple of months ago, and it's now all the way back to retest that support level. So here's the breakout level here, a zoomed in version of that on the right hand side. It's now all the way back to retest this level as support, and the question is whether this is now an opportunity for value to outperform growth again. Remember, after the November 11th November election, that's when we started to see value start to outperform growth, and it really accelerated here at the beginning of this year here, as the tech shares hit kind of their peak here in mid-February. That's really when we saw small caps outperform here. Now, if we start to see tech shares underperform again, that could be the catalyst that drives small caps and value stocks to start outperforming again here. And we're just near a support level here. So this is potentially that opportunity when we look at small caps, as they have kind of held back over the past few weeks and underperformed severely, is this now the opportunity? So this is one that we're paying attention to very closely, because the risk to reward ratio here certainly skews towards better for value to outperform growth. And then when we look at emerging markets continue to put in lower lows, lower highs, and continues to trend lower here. So this is not particularly strong here for equities for emerging markets, but it is slowly finding a little bit of support here around the $60, $52, $53 level here. We would like to see this breakout above this 54, 55 level for EEM to continue moving higher, especially with dollar starting to weaken here. That is a potential catalyst for emerging markets to also start outperforming, and that would also be a good signal for equities to continue moving higher here. So the picture here is a little mixed. It's not particularly overly bullish here, but that also means that, I think right now the question is just where along the risk spectrum, or where along the spectrum do you want to look for potential opportunities within equities? It certainly is not in technology. It's certainly not in the S&P 500. It's perhaps in the small caps, perhaps in the emerging markets where they've been lagging behind. But as dollar starts to decline here, as interest rates starts to decline here a little bit, you start to see some outperformance here for small caps and emerging markets. And then when we look at the 10-year yield, the 10-year continues to moderate here around this 160 basis point level here. So the 10-year yield has seemingly found a bit of an equilibrium around 160 basis points. And this certainly puts, the initial targets of back getting into the 195, I think less likely here. I think you're more likely to see a range bound around this 150, 170 level, around the 160 level for the foreseeable future, especially as the Fed continues to hold, rates here at a relatively all-time lows for the foreseeable future. And the language from Chairman Powell is fairly strong on that. I think that has put a stop here to how much higher the interest rates can move much higher here on the 10-year yield. And especially if you look at TLT, we have seemingly put in what looks like a bit of a bottoming formation here for TLT. No longer having lower lows and lower highs, we now put in a successful higher low and higher high. So as you start to see a bit of an uptrend start to emerge here for TLT, that also is a good signal that the 10-year yield, in terms of the rally on the 10-year yield, is coming to an end, or at least starting to moderate and finding a bit of an equilibrium. That's going to put equities back on the front foot here again. We really have seen the rally here in the 10-year yield put a drag here on equities, but as the 10-year yield stabilizes, that's likely going to put a more of a risk on trade here for equities. So all things, when you look at things on balance, still favor equities here at the moment. However, it is important to look at where on that risk spectrum do you want to be within the sector rotation, and also within, whether you're being in mega cap or small cap. In my opinion, right now, it favors more of the smaller cap emerging markets. And then we look within the sectors, last week, over the past couple of weeks, we have talked about how consumer discretionary and technology, these two green lines, are the ones that have been leading the markets higher, while every other sector was moving towards the lagging quadrant. Only technology and discretionary was moving in the leading quadrant. But over the past few days, we've started to see discretionary and technology start to lose some relative strength here. And what we're starting to see here is a lot of other sectors that were weaker, like communications, healthcare, financials, industrials, materials, consumer staples, utilities, real estate, start to move away from the lagging category and start moving towards improving categories. So this type of sector rotation is healthy for a market rally. And the question is whether this can continue. So far, it is looking like discretionary and technology is starting to lose some ground here, and we're starting to see quite a few of the sectors coming back up into that improving category here. So as you're looking for rotation here, out of the higher beta technology and discretionary sectors into the more defensive financials, healthcare, communications, materials, industrials, consumer staples, utilities, real estate, really a vast number of sectors here that are starting to see more strength here versus the relative to the market, and even energy starting to come back to life a little bit, moving towards the improving section here. So you really have 9 sectors starting to either already improving or getting into that quadrant of improving, and some that are weakening but no longer weakening anymore and actually starting to move back up into the leading category with utilities and real estate, 2 sectors that I still quite like here for the current market environment that we're in. So as you're stuck in this hard place, against the hard place in a rock, it's difficult to figure out where do you want to position. But, when we look within the data, there are still opportunities, again, within certain sectors and within certain caps of the market. So looking at gold here, looking at some commodities here, I do want to point out gold, because gold has managed to break back up towards what is a fairly significant level, 166. We've been talking about this level as resistance. And the question is whether gold can break out above this 166 level here. So after one day of closing above 166, it did end up closing below 166 again here yesterday. My views are still that gold is unlikely to outperform here, but we really have to watch this. If it can break above 166, I think that is potentially meaningful. But my views here are that gold is unlikely to break out above 166 significantly, and more likely to underperform here going forward, especially as you see interest rates potentially moderating around this 160 basis point level. But again, pay attention to these levels. For those of you that are gold investors, this could potentially be a breakout level to watch. Now, when we look at the economic data here, this is really where a lot of the surprises we saw out of March It's starting to decelerate a little bit here. We saw a lot of outperformance in terms of economic numbers, surprising to the upside. Everything from services to manufacturing to job growth across the board, including consumer sentiment. But in right now, we're starting to see that slow down a little or decelerate. It's still improving, but decelerating. The survey was about 89, but the actual came in 86.5, a little softer than expectations. And this really comes down to quite a few different things. Not only is consumer sentiment decelerating, but we're also seeing manufacturing sentiment sour a little bit from the perspective of the expectations for number of employees in 6 months has jumped substantially, meaning manufacturing companies are expecting that over the next 6 months, they're going to do a substantial amount of hiring. As you can see, we're talking back to, prior to 2008 type levels here. We have not seen this over the past more than a decade in terms of this type of optimism or need for manufacturing. But when you look at the underlying premise of manufacturing, there are some concerns here. This really comes down to labor and price pressure here. Right now, expected delivery times have started to increase substantially. As you can see, we've never seen these types of levels going back the past 15 years or so. Then this really comes from the supply chain issues that were starting to emerge here. As you can see, unfilled orders at 15-year highs, prices that they have to pay for goods to manufacture goods is at near all-time highs. So labor costs are becoming increasingly pressured higher here as unemployment starts to plummet and the number of employees seeking jobs are actually decreasing. The supply chain has significantly squeezed manufacturers' ability to get access to raw materials, and they are finding themselves paying higher and higher prices for those raw materials. And that's likely going to play out in terms of inflation for consumer goods here. So this is some of the inflationary concerns that markets have started to price in here over the past few months, and these things are not easing. They're actually getting worse. So these are some of the things that we really need to start paying attention to with respect to inflation expectations and what that means for us when we are looking out the next 3 to 6 months and beyond for consumer goods, for consumer staples, and for consumer discretionary, as these manufacturers are finding it more and more, finding it harder and harder to fill orders and deal with the supply chain issues that are starting to emerge. So when we look for opportunities here in the market, there are multiple ways to look at this right now. And I do think that despite the weakness we've seen from some of the tech names, there are some opportunities starting to emerge here, especially for names that are fundamentally sound, that have seen a substantial amount of multiple contraction, that may be nearing a bottom here. And one very, very popular name that largely we have stayed away from because of the hype is starting to become a little bit more attractive here, especially as you look at the fundamentals, and that's NIO. NIO, obviously, many of you know, has had a very spectacular run and also a very spectacular fall from grace since that. And we are near at this point where we've had these, what we call a triple bottom, with a bit of a positive divergence here, where as price made effectively the similar lows, RSI made higher lows. These are usually some of the signals that we see near market bottoms here. And this is a potential opportunity, in my opinion, for those of you that are long-term investors in electric vehicles, to look at a popular name here like NIO as a potential opportunity after it has declined roughly 50% from its peak. So we've had a very strong uptrend. It's declined almost 50% from its peak. It could still have some downside here. That's the risk that you have to take. But that's why I think the type of strategy that makes sense here is selling a put spread. You can control your downside risk and look for a bounce higher here. And if you get clearance above this $42 level or so, then you could look at establishing a bigger, longer term position here. If you get back above 45 or so, that certainly puts this back into the $60, $65 range here to the upside, if you have the breakouts here to those levels. But you're starting to get to that point where, as you can see, money flow that has been fairly weak here over the past few months have started to turn positive here on the daily. The weekly money flow that has been weak is starting to turn positive here again. So And looking at the fundamentals here for NIO, this is the by far out of the three Chinese electric vehicle car manufacturers, the largest of the three. It still grows as fast as those two smaller ones in terms of deliveries growth. That is fundamentally stronger. And I would admit, out of the three manufacturers, I think NIO probably has the least long-term beneficiaries, if you will. It's not invested heavily in some of the longer term technologies that are likely going to play to its growth. But when we look at a stock like NIO, their short-term vision, I think, is probably a little bit stronger than the two other competitors here. So for those reasons, I think NIO is an interesting opportunity here as you see these multiple, you see this triple bottom here as you have the positive divergence starting to show here for a name like NIO. Another one I want to pay attention to is Disney. This is one that we've been talking about as well. Disney doesn't report earnings like Netflix later this week. It reports a little bit later here, but it has found a really nice base here above this 180, 183 support level here so far, holding these levels near that support level. So that's why I think this is still an opportunity here to the upside. Same thing like NIO. I think selling a put credit spread here is suitable for a name like for Disney, especially since it's clearly outpacing Netflix here. When we look at a name like Disney, especially if you look at the fundamental underlying data for Disney Plus versus Netflix, they're moving in opposite directions. One is accelerating and growing, one is decelerating and not moving in the right direction. And that's referring to Netflix, which reports earnings later here this evening. Revenue growth is slowing for Netflix versus Disney is accelerating. The number of subscribers in the US for Disney Plus is still continuing to accelerate. If you look at downloads, Disney Plus and Amazon, the only two of the streaming category that continues to grow in terms of downloads, while streaming services like Netflix and Hulu are starting to decelerate or slow down in terms of downloads. So, when you look at that type of data, that's really starts to show a bit of a bifurcation here in the streaming space. And Netflix, which is still by far the largest player in this particular space and still has expansion into international markets that will provide, will still provide growth for it in the future, and it's becoming that more of an established player. But trading at 53 times next year's earnings, Netflix just doesn't have the growth, in my opinion, to support that type of multiple that it's still trading at. It has come down substantially in terms of multiples, but I still believe that Netflix is a little bit overvalued here compared to some of the faster growing streaming names like Disney. And lastly, looking at Snapchat, especially when you look at some of these tech names, I've been very bullish on Snapchat here over the past two earnings cycles here, but I do think that where we are right now is fully priced in the growth we've seen in terms of Snapchat. For those of you that followed me on CNBC, I was long on both of these earnings announcements last two quarters, but this reporting earnings here in later this week, this is really where I start to see a little bit of weakness here. And this is the type of earnings report where I don't necessarily expect the earnings report itself to be weak. I just simply believe that the price action off the back of that won't be particularly strong. As we've seen with a lot of, the banking names we've seen over the last few weeks, that stocks that have reported very strong earnings have underperformed on the stock price. I can't help but think technology shares is coming to an end in terms of multiple contraction. We're likely going to see some of these names that have seen substantial growth since the start of the pandemic start to show that growth is decelerating, especially as things reopen. And with interest rates at 1.6% versus 50 or 60 basis points at the time that the earlier reports were put in, that really puts the multiples that these stocks are trading in difficulty, in my opinion. So especially when you have a stock like Snapchat that has underperformed the sector. Not only has the stock underperformed since the last earnings announcement, it's underperformed the sector. And that's really the type of poor relative strength that I typically look for weakness. And I think that Snapchat could very well revisit the $52 to $48 level here to the downside. This is an earnings play, so you can either use a debit debit spread, limit the amount of risk that you're trading on this, buying something like a 61.52 type debit spread here, or you can sell a credit spread here as well, an upside call credit spread that will profit as long as Snapchat stays below, let's say $61 or $62. Whether it falls or plays sideways, you're profitable in both scenarios, versus a debit spread does require the stock to make a substantial move here to the downside in order for that strategy to be profitable. So that's how I'm currently viewing this market, because like I said, the broader markets are by all means overbought. I don't think going long the equity markets, in my opinion, is the best timing from a risk to reward perspective, but you're also stuck between a hard place because there aren't some substantial short opportunities, in my opinion. If any short opportunities, they're relatively limited. I think you want to stay in names like Snapchat, Netflix, these types of very high multiple growth names that are starting to decelerate. Those are the ones that you may see some underperformance in. Even Intel, but Intel's not trading at such rich valuations as Snapchat and Netflix are. So that's why I'm taking more of a bearish view here on names like Snapchat and Netflix. Taking a more bullish view here on names like Disney and the communications. We're seeing communications starting to outperform here, and you have to look for strong names within communications for that, like Disney. And then, within the high tech growth names, Neo, interesting play here from the perspective of it has seen a substantial decline here. It's put in a nice support here around 35. Perhaps it's time to start taking a look at some of these names here as well, especially for those of you that are longer term investors looking for an opportunity to get into some of these stocks at what, not at these crazy valuations that it was trading at a few months ago, because it has seen quite a bit of delivery growth since these earnings reports here as well. So think about it. When it was back here, the number of deliveries were substantially lower than where they are here, and you're getting them at the same price, which means that you're getting them at a cheaper valuation. So for those reasons, that's why I'm taking a look at stocks like Neo. So with that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding as to the broad view of the markets, where we currently sit, the health of the market rally, this, where the sectors are rotating, where you see some strength, where you see some weakness. So you're trying to position yourself within this market, understand where the probabilities are skewed in your favor, and then how I'm thinking about the markets with this. So with that, I want to thank our members for supporting us and allowing us to continue to do this every single week and providing you the insights into the broader markets and what my views are. So if you're currently if you're not on a free trial, you can sign up for one at OptionsPlay.com. It'll give you access to all of the services, including these market outlook sessions, our trading signals that we send out every single morning, as well as our weekly education. And for those of you that are currently on a free trial, if you want to join us as a member, you can join us using the link here on your screen. That'll give you continued access to everything and allowing you us to continue doing this going forward. So with that, thank you so much. Have a great trading day, and we'll send you the recording to our members as soon as we finish processing this in about half an hour or so. Thank you so much and have a great trading day.